Hey guys, how's it going? It's Andy from Go Investing. Happy Wednesday. Tuesday was a relatively green day on the stock market, with the overall market getting pushed up by consumer products and tech overall, which has kind of been the case for like the past 2 months. We also had Apple, which hit an all-time high of 372, and it's up more than 25% year to date. And this is a stock that I talked about kind of recently, and I was surprised that it hadn't been doing as well when I talked about it like a month ago, and it has been pushing up significantly in the past couple weeks, and as I mentioned, it just hit an all-time high. Some other news from yesterday is that Dr. Fauci came out and said that the next couple weeks are going to be very critical to see how the overall economy in the US is going to be doing with a potential second wave of the virus. And so living up in Oregon in a small college town when most of the people that lived here moved out the second that the pandemic hit, this is a very different world than what we're seeing across the country. So it's very interesting to see that California had almost as many new cases yesterday as Oregon has had total. So that's going to be something I'm going to watch going forward, and just be safe out there, everyone. In today's video, I'm going to be making a round 2 of a video that I made probably about a month ago, which was 5 cheap stocks to buy, and I'm going to be doing that again. But in today's video, I'm going to be doing it with a slightly easier kind of restriction to it. I'm pretty sure in that last video, I tried to do things under $25, and now I'm going to be doing it under $50. And I understand why people want to have cheap stocks in their portfolio, because when they see cheap stocks, they usually think of a lot of upside potential. But at this point, most people can buy fractional shares on Robinhood, so there's no really restrictions on how expensive a stock can be for you to have to buy it. In the past, if you wanted to buy a share of something like Amazon, you needed a lot of cash. But at this point, you can buy fractional shares. But this kind of gives me a little bit of a challenge to pick stocks under $50, and today I found 5 of them that I think have a lot of upside potential. Some of them are extremely risky, and then some of them I think are fantastic long-term plays. Before we get started, I have to say that I'm not a financial advisor, and this is financial advice. I'm just a 23-year-old guy talking about what I think about the stock market overall. Also, if you've been enjoying these videos, I really appreciate it if you hit that like and subscribe button, as it would help my channel out a lot. The first stock I wanted to talk about is something that I've never actually discussed on this channel before, and that is Sonos, ticker symbol SONO. As of right now, Sonos is trading for around $14, and it's down 9% year to date. When we look at the 1-year chart, it looks pretty typical for what we've seen of the overall market. You have a ridiculous crash going into March and then a significant recovery. And so that's pretty on brand for one of these smaller stocks that's mainly getting pulled up by the rest of the market. When you look at the all-time chart, it's pretty short because the stock IPO'd in the second half of 2018. And so it's far enough along where the lockup date for shares is over at this point, so I'm not worried about that. The lockup date is a restriction for recently IPO'd stocks where insiders who are a part of the company have to wait a certain amount of time before they can sell their shares for a profit. When stocks go IPO, you have a lot of the people inside the company that make a lot of money really quickly, and a lot of times they want to liquidate their shares, maybe buy a house, maybe buy some other shares, but it's usually a time where there's a lot of selling for the stock, and so that's usually why I avoid IPOs at all costs. So when I look at the stock overall, it's pretty speculative, and I've done pretty well on picking speculative stocks in the past. I had a nice 100% gain with Roku last year, and this is a stock that I feel pretty similar about. At this point, I've seen some rumblings, a couple of news articles that have popped up recently that have made me feel really bullish on Sonos overall. The first one is that Citron, which is an investment group, put their price target for Sonos at $30. This is probably the largest gap I've seen in a long time between the actual price and an estimate for a investment firm. And so at this point, Sonos is trading for $14 and they have their price target as $30. That is more than a 100% jump in price. And that is not something that you see very often. Usually I like to see like a 15% difference, but 100% makes me feel like Citron is very bullish on Sonos overall. So Sonos, if you don't know, is a connected speaker, which has kind of become a popular trend with a lot of these major companies like Google, Amazon have made their own, but Sonos is probably the highest quality product out there. And one of the things I really like about it is its brand loyalty. This is something that I've talked about a lot on this channel, specifically with companies like Apple, where their brand loyalty is so high that I'm not really worried about the short-term kind of chop with the overall market, because people love their products and will continue to buy them in the future. And that's what I've seen a lot with Sonos. One of the really interesting things I found from some articles was the fact that for people that already own Sonos products, the average household has 2.9 Sonos products. So it's not like they're just buying one of them and being comfortable with that. They're connecting their whole house, and they have almost 3 products per household. So that just shows that the brand loyalty is very high for this product, and it's something that I'd want to be a part of going forward. And the second and probably the main reason why I'm bullish on Sonos overall is that there's been some rumblings about a potential acquisition from Apple. And anytime Apple gets put into the equation, you have to kind of compare the two products. And when you look at Sonos compared to Apple, you see a lot of similarities in the quality of the product and the brand loyalty that you have overall. So it seems like a perfect fit to me. Anytime you have rumblings of a massive company acquiring a smaller tech company, that usually shoots the price up significantly. We saw that a couple months ago when there was some rumblings that Google wanted to buy Fitbit, and the stock price shot up. And so right now, the fact that the price target's currently sitting at around $30, and there's been some rumblings that Apple may try to acquire Sonos in the future, makes me feel very bullish on the stock overall. When you look at the overall market share, it's relatively low at around 5%, and it's mainly because you have Amazon, which has been the dominant force in this area. But when you look at the quality of product and some of the trends that you've been seeing, I like the trends going towards Sonos. In the past year, they went from 2.5% market share to 5%, which is a double. It's still only 5% and not that high, but when you compare it to Amazon that went from 61% at the end of last year down to 53% at early 2020, you're starting to see that Amazon's losing some ground, and that could leave the door open for a company like Sonos to come in and take more of that market share. And as I was making this video, the news report came out that Sonos is cutting 12% of its workforce internationally. That's something where you have to take that into account. Usually it's short-term benefit for cutting employees because it lowers the cost, but it's something that you're going to have to watch going forward and if you consider taking a position in a company like this. So I've made my case for why I like Sonos as a stock, ticker symbol SONO, and I'd love to hear what you guys have to say about it in the comment section down below. All right, next up, I wanted to talk about my favorite airline stock. And for once, it's not actually Delta. Today we're going to be talking about Southwest, ticker symbol LUV. Currently the stock is trading for around $33.60 and it's down 37% year to date. If you've been on this channel for the past couple months, my favorite airline stock for the longest time has been Delta, ticker symbol DAL. The main reason behind this is that Delta is the largest airline in the world, and I expected them to bounce back very well when things started opening up. They have the highest amount of margin, which means that they're very efficient at taking revenue and turning it into actual pocketed income. And so that's very positive when you're looking for a company to kind of bounce back after a tough time like this. But there's been some news articles popping up yesterday specifically that has made me kind of switch my tune. And whenever I have a change in opinion on a stock or an overall sector, I want to tell you guys how I feel about it. There's been some talks that the EU, the European Union, might have some travel restrictions or an overall ban on American travelers when they reopen their borders. And this would be a huge problem for places like Delta and American. The reason I really like Delta is because they have the largest airline in the world, and I thought that when things start opening up, it would be fantastic overall. But I didn't really take into account the fact that the United States would be kind of the epicenter for the overall pandemic. At the very beginning of March, you had Trump shutting down travel to European citizens going into the Americas, and that kind of pissed off a lot of leaders over there. And so there's been some talks that this might be a retaliation move, or it could just be the fact that America has not gotten the pandemic under control here. But in any case, the reason I like Southwest more than something like Delta right now is they are mainly a domestic carrier. They do have some international flights, but it's mainly to Canada, Mexico, and maybe some of these South American countries. But it's not to far-off destinations like Asia or Europe. And so with their really low operating costs, based off the fact that they fly pretty much the exact same plane for their entire fleet, and the fact that they have low costs, which might be a positive for people that are looking to take advantage of cheap prices and be able to make up for the lost time when it comes to vacations, I'm starting to like Southwest as my favorite airline compared to something like Delta, which I had felt very positive about in the past couple months. Obviously, there's still a lot of risk when it comes to the airlines. You've seen a lot of volatility, you've seen a lot of what I think could be potential market manipulation for the airlines, and so there's a lot of risk associated with airlines. But at this point, I think my favorite, and if I had to pick the safest stock from the airline industry, it'd be Southwest, ticker symbol LUV. Let me know what you think about Southwest and the overall airline industry in the comment section down below. All right, the third stock I wanted to talk about is PENN National Gaming, ticker symbol PENN. Currently, PENN is trading for $34, and it's also up 34% year to date. That 34% year to date doesn't seem that impressive, even when we talked about Apple at the very beginning of the video, which has had similar returns so far in 2020. But when you look at the fact that PENN hit lows of below $4 and it has bounced back significantly since then, it's pretty crazy to look at. When you look at the one-year chart, it's been really interesting. It was relatively stable, then in February it spiked, then it crashed with the overall market, and then it has recovered significantly, and now it's up almost 35% year to date. As a result, PENN isn't something that I would buy and hold forever. I think there's a lot of risk associated with a company that has recovered from lows of below $4 and is now trading for around $34. But at this point, there's been a lot of hype surrounding PENN National, specifically from Barstool founder Dave Portnoy, which has been really interesting because he has mainly been a sports bettor and has recently switched over to trading stocks. I don't want to say investing because what he's doing is not really investing, it's more of trading, but it has gotten a new generation of people interested in the stock market. Based off the fact that PENN owns a significant portion of Barstool, I'd expect that many of their viewers own shares of PENN. And as a result of their cult following, I don't expect that to change anytime soon. When you see the crazy price movement that PENN has had in the past, I wasn't expecting to see a lot of positive things on the overall fundamentals. I was expecting to see a very overextended stock. But then when I look at the revenue, specifically in the past couple years, there's been a rapid increase in the past 12 months, which is something that I wasn't really expecting. And so that jump in revenue kind of justifies the overall increase in price. Maybe not going from $3.75 up to $34, but it makes sense why the stock has gone up a little bit over time. At this point, PENN National owns 41 gaming and racing properties across the United States, and at this point, 30 of them are open. So they're starting to get their business back open, and so it'll be very interesting to see if this second wave affects them and if they're going to have to be shutting down their properties again. Overall, this is a stock that I'm not sure how I feel about it overall. It has a cult following from Barstool, and it has recovered incredibly well since the lows in March. But I just can't really justify buying a stock that's gone from below $4 to $34 in just a couple months. This is a stock that I would be looking to buy if a second wave of the virus comes and they have to shut down a majority of their overall properties. And if I can get the stock at a discount relative to where it is right now, I would consider buying this for a long-term position, but I can't really justify buying it at this price. That being said, I wouldn't be surprised if this stock continues to rise in price over the next couple weeks. There has been a lot of momentum with the stock, and momentum is a fantastic thing to have on your side when you're buying and holding a stock for a short or a long-term position. With that being said, I'm very curious to see what you guys have to say about PENN National, ticker symbol PENN, in the comment section down below. All right, and now we're going to make a little bit of a switch in the overall types of stocks we're looking at, and we're going to go from speculative stocks to some of the more stable companies out there. And today we're going to be talking about Cisco, ticker symbol CSCO. Currently, Cisco is trading for $45, and it's down 6% year to date. For those of you who don't know, Cisco is a networking giant, and they do mainly software and a little bit of hardware. They released their earnings in the middle of May and beat expectations on a lot of their things. As I've mentioned in my last video, and if you missed that, I'll link that above right now, I'm kind of worried about the fact that many companies are cutting their guidance. But somehow Cisco released their earnings and beat expectations from the market, and the stock went up a little bit. Going through that earnings report, one of the things that I really liked is that 74% of their revenue from software comes from subscriptions. And when you look at subscriptions, that might not seem super important. But as we're going into overall market chop and a potential recession, when I see that high of a percentage of your revenue coming from subscriptions, I see overall stability, and that's what I want to see for a long-term potential investment. This is also a stock that has a nice dividend of around 3%, and so that's something to take into account as you're potentially looking at the stock for a position. When you look at the one-year chart, you can see that the stock looks slightly different than everything else that we've talked about so far, with it falling for a majority of the past 12 months. But then when you go to the 5-year chart, you can see that it has more of the stability that you'd want in a long-term investment, and it's not just been in a constant downturn for the past 5 years. When I'm looking at buying tech stocks, you do have to take into account a potential trade war part a million at this point with China. And so when I'm looking at tech stocks, the fact that Cisco is heavily invested into software and not as much into hardware is a very positive thing for me overall, because if China comes out and puts some more tariffs and then the US retaliates, software is going to be mainly protected. Hardware is going to be where things get hit the worst. And so I see that as a plus for Cisco overall. Compared to something like PENN or Southwest, Cisco isn't going to be doubling in price in the next couple months. But I do think based off of the charts and what we've seen over the past 5 years, I think you could be getting a fantastic product at a pretty nice discount. And so it's something I'm going to be looking at taking a position in for a long-term investment. Let me know what you think about Cisco, ticker symbol CSCO, in the comment section down below. All right, the last stock I wanted to talk about in this video is Coca Cola, ticker symbol KO. This is a stock that I talked about a long time ago in my recession-proof stocks. But at this point, the company has not been doing so well in the past couple months, sitting around $45 and down 18% year to date. In that recession video, I talked about Coca-Cola as being a potential buy for a recession, mainly because a lot of consumer staple products, stuff like Coca-Cola, aren't really going to decrease in demand that much during a recession. But I did not take into account stuff with the pandemic hurting their supply chain. But I did not take into account that a lot of the places that make up a significant portion of their revenue, stuff like stadiums, restaurants, movie theaters, were going to be shut down. But going forward, we're looking like we're going to be hitting a recession. And the fact that a lot of these stadiums, restaurants, and movie theaters are starting to open up makes me think that Coca-Cola could be a great opportunity for a long-term investment. This is one of these blue chip stocks that you can still get at a significant discount, being down 18% year to date. When you look at the one-year chart, Coca-Cola looks a little bit different. It fell with the overall market, pushed up in April and has been relatively stable ever since. And from what I'm seeing there, it looks like things are waiting to open up fully, and there's not been a lot of positive momentum for the stock. And so that could be a positive thing, it could be a negative thing. I don't really know at this point. But for a blue chip stock like Coca Cola, being down significantly from its all-time highs, when you look at the overall market, and a lot of these impressive companies like Apple, Microsoft have recently hit all-time highs. And being able to get something like Coca-Cola at a discount is not something you can say about a lot of these other giants. Coca-Cola isn't a company that I'm worried about in the short term. It has been incredibly stable for over 100 years. It is a dividend king, meaning that they've increased their dividend for 50 straight years, and they're actually at 58 straight years. This is also a company that's known for bringing in very high levels of cash flow when they brought in $10.5 billion in the past year. Right now, this stock is not doing incredibly well like the overall market, but I do think for a long-term potential, this could be a price that I'd be willing to buy at. I'm excited to see what happens as things start to open up fully, and I think that Coca-Cola could be a great opportunity. Let me know what you think about Coca-Cola, ticker symbol KO, in the comment section down below. So that's it. Those are my 5 cheap stocks to buy going into July of 2020. I have a variety of stocks in this video. You have some speculative stocks like Sonos, Southwest, PENN National, and then you have some more stable stuff with Cisco, and then finishing up the video with Coca-Cola. So I think there's something for everyone in this video. Obviously, you have to do your own research before taking positions in any of these stocks. But going forward, I think Sonos might be my favorite from this video. The fact that there's been some rumblings about a potential acquisition from Apple, and the price target's being raised to $30 when the company is currently sitting at around $14, seems like a really good thing to me overall. For a long-term position, I really like Coca-Cola based off the fact that you're getting a blue chip stock at almost a 20% discount year to date. And so it hasn't done as well as the overall market, but it's one of these few blue chip stocks that you can get a significant discount still. But I'd love to hear what you guys have to say about these 5 cheap stocks to buy in the comment section down below. Thanks for watching this video, stay inside, and I'll see you in the next episode.